According to a recent report by the American Federal Reserve, 40% of Americans say they don't have the savings to cover a $40 emergency expense. Shocking, right? Unfortunately, financial education and personal finance management are rarely emphasized or taught in school. Most people grow up without knowing how to manage money, and even parents often lack the basic skills to teach their children. We can relate to this. Growing up in communism, financial literacy wasn't part of the curriculum. Even today, discussing money openly remains a taboo subject for many. But becoming wealthy is much simpler than most people think. If you learn the basic principles, it becomes easier to turn $100 into 1,000, 1,000 into 100, and 100 into a million. We'll share with you the blueprint that millionaires use to achieve the highest returns on their investments. Don't believe that you can do it? Well, a recent study showed that 8 out of 10 millionaires come out of families at or below middle income levels. In fact, only 2% of millionaires surveyed come from upper income families. In this video, we'll cover the blueprint that every wealthy person follows and show you how and where you can achieve the highest risk-adjusted returns so you can become a millionaire in 2025. Stick with us and find out. Strategy 1. Optimize for cash. Let's start with cash management. Many people don't have a clear idea of what they are spending or where their money goes. They know what's sitting in their bank accounts and what their credit card limits are. But beyond that, it's a cycle of waiting for the next paycheck. Wealthy people don't operate this way. To break the cycle, track your expenses and income for the next 60 days. Use tools like Rocket Money, You Need a Budget Every Dollar, or even an Excel spreadsheet. The key is to log every penny that comes in and goes out of your account. This allows you to spot patterns and identify unnecessary spending, whether it's dining out too often, buying clothes you don't need, or gadgets that aren't essential. Once you're aware of where your money goes, you can make informed decisions about where to cut back. Not keen on handing over your sensitive financial data? Well, check out our video on budget tracking to get you started. Just by tracking your spending, you could actually save 10 to 15%. With that newfound savings, you can start optimizing your finances. And there's never been a better to make money on your money. High-yield savings accounts are offering over 4% of annual percentage yield. While the average savings account pays just 0.46%, some high-yield savings accounts are offering rates over 5%. This means your money can grow just by sitting in the right account. We allocate about 20% of our portfolio into a mix of high-yield savings accounts and money market funds. This is our emergency fund for the short term, ensuring that we have money available for any unforeseen circumstances, no matter what happens in the short run. Strategy 2. Pay down high-interest debt. The average American owns over $22,000 in debt, primarily from credit cards, car loans, and personal loans. With today's interest rates, holding onto this debt could cost you thousands of dollars a year. Here's a rule of thumb. If the interest rate on my debt is higher than the return I'm generating from my investments, I pay off the debt ASAP. If the interest rate is lower, I'll pay it off slowly while using the income from my investments to keep growing. When it comes to paying off debt, there are two very effective methods. The first one is the avalanche method. This approach focuses on paying off debt with the highest interest rate first. Once that's cleared, you move on to the next highest, and so on. This method minimizes your interest payments and helps you pay off your debt faster. The snowball method is for those who prefer psychological wins. The snowball method involves paying off the smallest debt first, regardless of the interest rate. By eliminating one debt completely, you gain momentum and motivation to continue. Both methods are effective, so pick the one that works for you. Eliminating high-interest debt not only frees up cash flow, but also shields you from raising interest rates and financial stress. Do you like this video so far? If yes, please press like and subscribe. This way, you're helping our small but mighty channel to grow. Strategy number 3. Choosing your investments. Building wealth isn't about getting rich quickly, it's about following a proven strategy. With the economy constantly changing, having a solid investment plan is key. Here are 4 fundamental principles. First one, diversify. Spread your money across different companies, sectors, and asset classes. Diversification is crucial because, as seen in the late 90s, markets can be volatile. For example, the Nasdaq rose by 800% from 95 to 2000s, only to fall by 78% by 2002. Diversifying helps protect your investments from dramatic downturns in one area. Secondly, don't try to beat the market. It is tempting to pick individual stocks or chase alternative investments in hopes of higher returns, but the reality is that most people fail at this. Instead, focus on low-cost, stable investments that track the overall market. Number 3. Research index funds. Warren Buffett famously said that index funds are the best investment for most people. These funds cover a broad range of stocks and industries, offering diversification at a low cost. Index funds are perfect for anyone looking for a reliable, long-term investment strategy with minimal maintenance. Number 4. Buy and hold. Once you have diversified and chosen your investment, stay the course. Invest regularly and don't panic during short-term market fluctuations. This approach, known as dollar cost averaging, helps smooth out the effects of market volatility. Long-term investors like Warren Buffett, Jack Bogle, and John Templeton have proven that buying and holding is a powerful strategy. Strategy number 4. Inflation-resistant income streams. As inflation remains a concern in 2025, it's important to create income streams that resist inflation. Here are a few strategies. Number 1. Real estate. Real estate tends to appreciate with inflation, making it a stable, income-generating asset. Rental properties, for instance, can provide consistent cash flow while increasing in value over time. Number 2. Dividend stocks. Look for companies with a strong track record of paying dividends. Dividend stocks not only provide reliable income, but can also increase payouts during inflationary periods, offering a buffer against rising costs. Number 3. Digital products. For those with an entrepreneurial mindset, consider creating digital products like online courses, ebooks, or subscription services. These products offer passive income and scalability, making them particularly valuable in an inflationary environment. By building income streams that can keep pace with inflation, you'll protect and grow your wealth, no matter what happens to the economy. Ultimately, if you want to build massive wealth over the long term, it all starts with the basics. Optimizing your savings, reducing high-interest debt, investing in tax-advantaged accounts, diversifying your investments, and setting realistic expectations. The key is consistency. Stick with your plan, and over time you'll see the results. Thanks for watching. Comment below with your wealth-building goals for 2025. Let's work together toward financial freedom. See you in the next video, and don't forget, you got this!